Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So the best time to buy stocks is when they're down. And what I mean by that is when basically the overall market is down, not just because the stock is basically no longer doing what it's supposed to do, it's not a high quality company, but what I'm talking about is when the entire S&P 500 is down just because everyone thinks the world is about to end. And I think January has not been great so far for the stock market. And potentially we might be getting a very good opportunity to actually buy high quality businesses, because remember, in the end of the day, the S&P 500 might be down, but there are 500 different companies. Majority of these companies are great businesses. Everything is still perfect. They're making a great profit. It's just the sentiment that has changed, and people think the world's about to end and the market is going to go down. So if you look at it today, for example, the S&P 500 is, and the Dow Jones is actually all down. There's a lot of red when you think about it. But overall, if you think about it for the last 3 months, for example, if you change it, you can see there's a lot of green, if you like, especially the big boys. There are a lot of companies that are up over 20%. There are a lot that down, just companies like Adobe and so on, down a lot. So what I want to do is now just kind of explain, basically show you guys 5 different companies that are currently undervalued. And if you look at the fear and greed basically index, which tells us basically the sentiment, like what people are thinking of right now, the momentum. Is it basically people right now, everyone's basically fearful. Everyone is thinking maybe the stock market is going to go down, and people are selling. People are a bit worried about the stock market. Whereas a few weeks ago, we were here on the greed side of things. So I'm hoping we will get to extreme fear, because that's when you actually will get a very good opportunity in buying high quality businesses. And I'm going to share with you guys 5 companies that are undervalued at the moment that you could potentially add it to your watch list and wait for maybe even basically bigger pullback. But for now, at least add it to your basically your watch list. But before we get to the video, if you can join us at the Patreon account, that would be absolutely amazing. You got access to a lot of things, including the family portfolio and so on. So that would be absolutely amazing. Let's get to the video, because I don't want to make the video any longer than it needs to be. Again, we're looking for the same things. We're looking for the market cap. We're looking for the moat of the business. We're looking for if they have a dividend, any dividend. If they're paying basically dividends, we want to see the yield, the payout ratio, which helps us to understand how much of the net income they're using to actually pay us dividends. We were looking for the latest increases, the 5-year growth rate, and so on. And the other thing we're also looking for is profit margin, return on equity, return on invested capital, as well as the free cash flow, and then expectations moving forward. And then, of course, the Morningstar valuation, which is basically what I have been using over the years. And the first company we're looking at today is AMD. AMD is down quite a lot, over 20% for the 1 year. So it's one of the companies that potentially, this company, although is down, almost a 5% down today, is down 20% for the 1 year. So it is a great opportunity to potentially look into this one. And currently has a market cap of 198 billion market cap. And in terms of growth side of things, this is where I think there's a bit of a disconnect between what the company is expecting and what investors are thinking about the company right now. They expected EPS to grow about 52% basically next year, and revenue to grow over 26%. That's massive growth, right? And now in terms of profitability and so on, it's not the best out there. They do have free cash flow. They've returned 47% total return the last 10 years to shareholders, and they are really basically discounted right now, especially but after today will probably be about 28% discounted. So $160 per share is where they think the price should be. Right now it's about 116. Of course, because of what's happened, semis are very cyclical businesses, and this is what is happening to this company. A few years ago, I don't know if you remember, if you've been with us, you've seen Qualcomm having actually negative basically EPS and revenue growth, and basically the stock was down a lot, and it has bounced back since then. It's up, I don't know, 30, 40, 50% or whatever. So it can easily change, and apparently Nvidia is going to take a lot of, when it comes to the data centers, that market is now basically taken over by Nvidia, but that's can easily change. So we will see what happens. But overall, this is probably one of the best companies out there, and it is cheap right now. We've already seen Adobe. Adobe is actually down a lot, 180 to 5 billion market cap. It has a wide economic moat. Right now it's trading just over $400 per share. It's about 29% discounted right now. $590 per share is where they think the price should be. And again, like I've always said to you, when it comes to Morningstar, it actually kind of gives you a margin of safety, if you like. So I think this company is even more undervalued, even more. And look at in terms of the profitability, in terms of what management are doing, probably one of the best out there. Excellent free cash flow. Total return is amazing. Double-digit growth expected. Again, this is another one that I own in my portfolio and family portfolio. So if you want to check that out, come and check it out. I do own as well AMD, recent addition to the portfolio. So if you want to check that out, come to the Patreon account where you will be able to see the entire portfolio. The next one is Nike. Nike is basically one of the companies that have had a horrible 2024. Or even 2023, to be fair, because for the 1 year it's down 30%. At one point, basically this stock was basically trading over $107 per share, and right now we're looking at about $70 per share. Now, in terms of the company has a white moat and $71 per share. You get excellent dividend of over 2%. I think at one point I used to own this company. I think it's 2021, 2020, and basically the dividend yield was about 1%, and right now basically it's over 2%, which is absolutely amazing. The payout ratio is very good. The latest increase was 8%. The 5-year growth rate of 11%, and dividend streak of basically 12 years. You get $1.60 for every share of that you own, and dividend safety is D- right now. Now, profit margin, return equity, return investor capital, it's okay, it's not the best, but free cash flow is $7.2 billion. With the new management, with the new basically CEO taking over the business, who's been there for quite some time. Hopefully he can do a basically turnaround for this business, because if you know the company, like every single time you watch any sports, you basically see someone advertising for this company. There are of course other competitors, but I genuinely think this is probably one of the best out there, probably one of the biggest as well. In terms of total return in the last 10 years, we're looking at about 26%, which is absolutely huge. EPS growth, basically they're expecting about 22%, and the revenue about 3%. So revenue growth is not the best right now, but we'll see what happens. 36% discounted right now. $112 per share is where they think the price should be. Right now we're just above $71 per share. So it will be interesting to see what happens to the company in the next few months. Danaher Corporation is the next one, 172 billion market cap, wide economic, $235 per share. Dividend yield is not the best, is 0.3. The payout ratio is only 14%, so they do have massive basically room to increase if they need to, and they are doing that double digits, so 13% increase. The latest increase was 13%. The 5-year growth rate of again double digits, 12%. Dividend streak of 10 years, $1.08 is what you will get for every share that you own, and dividend safety of basically an A rated, which is good. Profit margin, return on equity, return on invested capital, okay, not the best as well. Free cash flow, basically we're looking at about over $5 billion, which is absolutely amazing. Total return the last 10 years, again double digits, 13%. And the EPS they're expecting to grow about 11%, and the revenue about 5%. 16% discounted right now. $285 per share is where they think the price should be. And finally, the last company we're going to talk about is Canadian National Railway. This is one of the best railroad companies out there, and there's two of them in Canada. So it's this one and Canadian. The I think the other one, ticker symbol, I think is just a CP. I think 600, basically 64 billion market cap, wide economic, about $100 per share right now. Dividend yield over 2.4%. The payout ratio 46%. If you know me, you know I like the railroads. These companies do have a sort of a monopolized market. It's very difficult to get anyone else to start. They're basically a new business because the tracks are expensive, long, and no one wants to get into that side of things. So the companies that are out there, including Union Pacific and the Canadian National Railroad, actually kind of monopolized that market. The latest increase was about 7% when it comes to dividend yield, dividend side of things. The 5-year growth rate of 12% and streak of 27 years. I don't think they're part of the S&P 500, so they cannot be dividend aristocrat, but if they were, they would have been dividend aristocrat by over 2 years. Annually, they will have basically paying you $2.45. B minus is basically the dividend safety, profit margin, return on equity, return on invested capital, probably one of the best out there. 2.4 billion when it comes to the free cash flow, 6% return in the last 10 years, which is, I think that's probably better than the UNP or Union Pacific. EPS growth, they're expecting to be about 12%, revenue about 6% next year. Fairly valued right now. It's the only one that's fairly valued, but it is heading towards that, because if you look at the this price here, so $111 per share, right now it's about 100. So it potentially will be basically a undervalued very soon if it continues this way. So that's the 5 companies. There's a lot more companies that are out there that are really becoming very much undervalued. So in the next few days, basically, I'm gonna dig them out and inshallah share it with you guys. Like I've always said to you guys, there's a lot of these things take a lot of time and effort to the videos to put together. So if I genuinely would appreciate if you can join us at the Patreon account. Now let's look at from Sharia compliance side of things. Absolutely nothing to worry about. Canadian National Railroad is the only one that has a slightly interest bearing, basically debt, which is about 21%. The cutoff is about 30 or 33%, whichever you use. So that's the 5 companies I wanted to share with you guys. This is the portfolio. It's still ticking along. Goes up, it goes down every single day. I've made some buys today, which I will be sharing in the community through the Patreon account. So join us if you can over there. Have a wonderful day. Assalamu Alaikum.